due to the rate environment and how rates have changed, I know a lot of the debt that you lend is floating rate. How have your developers been handling the circumstances over the past few years?
I remember working with our team to kind of underwrite what we thought rents were, and we kind of had to think back to like, how bad was it in the global financial crisis from a rental standpoint in New York City?
Well, there's nothing better than New York. There's a lot of dysfunction on the government legislation side of the equation, which is critical, but we just talk about demand and we talk about the strength of the Northeast generally. We are at 1.8% vacancy, and it's been 2 decades. So it's been an unbelievable an extraordinary challenge for the city to deliver new housing. I think in 2024, there'll be 31,000 new units. If the city delivered 50,000 units a year, it would still be inadequate to address the demand. And so, that is both a good news and a bad news situation.
Just wondering what the difference is for you as a private developer versus a public REIT.
I was trained in a way to de-risk the developer position, but at the same time, you need to find a counterparty that understands that. So in the instances of the 1,000 units we have here in New York City today, we've rented a balance sheet, paid a private equity fund money to use their balance sheet. We have strong counterparties that can provide the completion guarantees themselves, but we're still non-recourse.
Real estate returns don't work at 50% leverage for the most part, right? So I think where's it going to go from here? I mean, look, you went from the days where a Lehman Brothers provided 90% of the capitalization to the Ozarks of the world providing 50% and then substituted with a mezz. And, we made this whole market in providing whole loan sort of execution and now still do a lot in that space and now offer the alternative, which is, the banks are just not in a position to be able to fund all the needs of borrowers out there today. And so private credit in some way, shape, or form, whether it's in the subordinate piece, the senior piece, has to fill a lot of this void. Insurance companies will fill part of that void as well. We had to kind of teach, in many cases, institutional investors what real estate private credit meant when we were going to investors in 2007 and 8 and 9. And now in the US, at least, they know what that means. And as that evolves, that'll create a much bigger investor marketplace for the private credit industry.
I like joking around, another day, another lender, because everyone's trying to get into the private credit space over the past few years. But interestingly, if you look at the data, since 2019, there's actually 33% less active lenders in the market today. So what do you make of that in terms of how hard it is to succeed in the private credit world?
Well, I think everyone tried to be a lender, right? A lot of the equity shops tried to add on a private credit business, but private credit is its own business within real estate, how to service, how to manage, and you need scale. So one of the things that we also found through a very challenging fundraising environment for all in real estate and in alternatives in general the last few years, if you're going to go to your investor and focus on one thing, you got to put your best foot forward and focus on what your core business is. And so when things are really hot, you can go with 8 strategies. When things aren't that hot, you go for your one strategy. So I see as many people that are trying to get in the business, there's some that are kind of saying, we have no scale here. We have no real value, and the mothership doesn't want to keep funding the credit business. So it's interesting. And then you're also seeing a lot of equity firms add on pref and mezz within their equity funds. That's obviously a function of the markets where we are in the cycle, but even more so, those groups need senior leverage to make a deal. So when banks pull back to sub 50% of cost, and these private credit firms or equity firms want to provide that pref between 65 and 80, there's still a need for someone to go 0 to 65. And that's one of the areas that we're seeing a great opportunity in.
The ideal situation for me is a whole loan with a single counterparty, non-recourse, and having it be 65% of the stack. And so those are the days we're hoping to get back to soon.
I personally think that a lot of these bearish prognostications go overboard and they're really just to draw headlines. Do you think there's concern?
I don't think we're going back to the world as we knew it. There needs to be some form of reckoning. And I see the crisis with the lenders sucking the air out of the room on everything else, as Josh said. There's so much exposure and so much anxiety and regulation where it's not really the bank's choice necessarily in how to deal with things, that it makes it difficult across all asset types, even for the projects that make a lot of sense.
How have you seen the deals based on the looming maturities? How have you seen the deal flow come in over the past few months and the opportunities that maybe you historically haven't been able to pursue?
Today, we're providing so many different products in the market. So we have, whole loan construction lending, or value add lending. We have transitional lending. We're providing credit to other lenders. So one opportunity that we've seen in this last few years has been, as banks have pulled back and don't have the liquidity to fund borrowers or maxed out on real estate credit, they have no ability to fund other lenders as well through A-notes, lines of credit, loan-on-loan financing. So we've found a very, very large business in being able to provide credit to other private credit funds and institutions. And if you think about it, if you believe private credit is going to take on a lot of the opportunity that banks had, private credit still needs leverage to be able to generate the returns needed to investors today.
What would it take for you to get back into the office space, or potentially maybe some office to residential conversions?
As MaryAnne knows, most don't work exactly as planned. There's some sponsors that are looking at downtown office to resi conversions. The real problem is, in many cases, they're not completely vacant, so you have tenancy in place, and the cost of carry just delays things so much that it's not really an effective business plan, and the layouts aren't always great. Ceiling heights, layouts, egress, so I think there's a few operators in New York City that really specialize in that. That's all they've done in their whole careers, and they have endless amounts of opportunity right now because they're picking and choosing their spots.
There are a few funds out there who are trying to actually raise specifically for office to resi conversions, and you just initially read the headlines about, hey, we're out there to raise, but they don't hear anything later because they're not able to raise the money.
And we ran the math, and the truth of it is that the value and the basis in the office has to be $150 a foot. And who's willing to raise their hand and say, okay, I accept that reality? Owners aren't going to do that, and lenders aren't ready to do that.
I mean, the hospitality market is another sort of market that we're seeing. Obviously after COVID, it was such a challenging market in New York City, and it's one area or bright spot in New York City today.
We have a program called the City of Yes because we're the City of No right now. You don't name a program the City of Yes if everything's going well. Right. So I think we have to become a City of Yes for all these reasons. I mean, the migrant problem alone could fuel an entire construction boom if it were framed, packaged, and delivered in a policy format that made sense. And real estate math isn't that complicated. Yeah. You can show anyone the numbers. There's no secrets. It has to make sense. Construction costs never come down, right? You just have to try to know. Labor doesn't come down. It's certainly not with the programs that have been adopted. So I think that there is an ability for us to do amazing things in this city, but it requires public and private leadership and partnership.
Of course, the stock market now is 3% around from all-time highs, and you're going to see funds being forced now to reallocate, which could be a boon. I know it's been a very tough first half of the year in terms of fundraising. How do you see that impacting the market as a whole?
I think you're going to see more and more of this LP equity coming in as it's sort of a self-fulfilling prophecy.
To get a piece of the Big Apple and to have a stake in the ground here, again, with the right returns. But if you're talking about long-term value investing, it can go the distance, right? You're not going to invest necessarily into a single cycle. You're going to invest through many cycles if you can be in New York City in prime real estate. So we have to remember that about New York, because for many it's not a moment in time, particularly if it's multifamily, because it's the best of the best. You can't replace it with anything any better. Office is bumpy and difficult and challenging now, but I think the multifamily business in New York is where everybody wants to be. It's just a question of how to get it.
The problem with core funds, so much of it was in office. But when you talk to institutional investors, what do they like about multifamily right now? I mean, fundamentals of supply and demand, and the fact that they think that there will be NOI growth, and if you believe cap rates are coming down, that's why someone's buying unlevered at the moment, or buying with the hope of getting better leverage later.
Moving forward, what do you see as the best opportunities?
Higher value add lending was something we always thought was a sort of a specialty of our business because we understand it, and then providing that kind of capital in a senior part of the capital stack also to be able to service private credit funds is also a unique opportunity for us.
We have an unbelievably robust pipeline of deals, and so to me it's about an efficient capital solution that involves a single equity source as a co-GP, and then some favorite LP capital. So I will go on a roadshow to lock down that equity piece because the lending environment is strong. It's really because of the work that firms like yours have done. I mean, you've created so many options for us.
Institutional sponsors like MaryAnne think about non-bank lending today in a very different way. 4 years ago, you never did a private credit loan, and that was the way it was. And today, I think going forward, even more so with the banking sector still in sort of a shell-shocked position, that's going to be the foreseeable future.
And you really have to explain this massive shift in the nature of the lenders. And the reason why that's important, because there's liquidity requirements, right? There's net worth requirements. And the liquidity is an issue because a lot of these funds want to put their money to work. They don't want to sit there and have money set aside to deal. So there's been a lot of those kind of changes too. So it's an education across the board.
I don't see banks completely coming back the way they once did. They'll be there to service clients, but they'll be there to partner with firms like ours to provide business in all different parts of the capital stack.
It's so awesome to not have to worry about a competitive landscape of lenders and creative lenders. What it means to someone like me is it's more optionality, it's a more competitive environment where I'll get a better execution. And so my plan for 2025 is to execute on what is a $2 billion portfolio of development in the New York metro area mostly, including New Jersey, and to have the capital at the ready.